Ever wondered how to manage your finances effectively? Let's start with the Rule of 72. Welcome to the fascinating world of financial rules. These rules are not just numbers and equations, they are the keys to understanding and managing your money better. Today we're kicking things off with the Rule of 72, often called the Double Your Money Rule. You see, the Rule of 72 is a simple way to estimate how long an investment will take to double, given a fixed annual rate of return. It might sound complex, but it's actually quite straightforward. Here's how it works. You simply divide the number 72 by the annual rate of return, and voila, you get the number of years it will take for your investment to double. Let's illustrate this with an example. Suppose you have an investment that offers a 6% fixed annual rate of return. To figure out how long it will take for this investment to double, you just divide 72 by 6. The result? 12. So, in roughly 12 years, your investment will have doubled. Of course, this is a simplified way to estimate doubling time. It doesn't take into account other factors like market fluctuations or additional contributions you might make over time. But as a quick and dirty rule of thumb, the Rule of 72 can be incredibly useful. So why is this rule important? Well, it gives you a quick way to understand the power of compound interest. It shows you how your money can grow over time, and how a higher rate of return can significantly speed up that growth. It's a reminder that investing isn't just about putting your money somewhere and hoping for the best. It's about understanding how that money can work for you. To sum it up, the Rule of 72 is a quick, simple tool that can help you make informed decisions about your investments. It's not a magic formula, but it is a handy guide to help you understand the potential of your money. Remember, the Rule of 72 is a quick, simple way to estimate the doubling time for an investment. So next time you're considering an investment, give the Rule of 72 a try. It might just change the way you think about your money. Now let's move on to the Rule of 114 and the Rule of 144. Imagine you've found an investment opportunity offering a higher annual return. You're excited, but how long will it take to triple your original investment? This is where the Rule of 114 comes into play. To apply this rule, you simply divide 114 by the annual rate of return. The result is approximately the number of years it will take for your investment to triple. Let's say you've got an investment with a 9% annual return. Applying the Rule of 114, you divide 114 by 9, resulting in roughly 12 and a half years. So, if you invest $1,000 today, you can expect to have around $3,000 in 12 and a half years. Now let's kick things up a notch. What if you're aiming to quadruple your investment? Enter the Rule of 144. This rule works similarly to the Rule of 114, but it's used to estimate the time it will take for an investment to quadruple. Suppose you found an investment promising a 12% annual return. Using the Rule of 144, you divide 144 by 12. The answer, 12 years, is the approximate time you'd need to wait for your investment to quadruple. In this scenario, an initial investment of $1,000 could potentially grow to $4,000 in 12 years. Of course, it's important to remember that these rules are approximations. They're great for getting a quick and easy estimate, but the actual time it takes for your investment to grow could be a bit more or less. Factors such as market volatility, changes in interest rates, and inflation can all impact the growth of your investment. Nevertheless, these rules are incredibly useful tools for planning your financial future. By understanding how long it might take for your money to grow, you can make more informed investment decisions. With the rules of 114 and 144, you can estimate how long it will take to triple or quadruple your money. Next up, the Rule of 70 and the 50-30-20 rule. Let's start with the Rule of 70. This rule is a simple way to calculate and understand the impact of inflation on our purchasing power. It states that if you divide the number 70 by the annual inflation rate, you'll get the number of years it will take for the purchasing power of your money to have. For instance, let's say the annual inflation rate is around 2%. If we take 70 and divide it by 2, we get 35 years. This means that in 35 years, the purchasing power of your money will be half of what it is today if the inflation rate stays at 2%. This rule is a quick and handy tool that helps us realize the importance of investing and growing our money to outpace inflation. Now, moving on to the 50-30-20 rule, a rule of thumb that helps you with budgeting. This rule is about breaking down your after-tax income and spending it in three categories: needs, wants, and savings or debt repayment. Imagine a scenario where John earns a monthly income of $2,000 after tax. According to the 50-30-20 rule, John should allocate 50% of his income, that's $1,000, to his needs. These needs would include things like rent, groceries, utilities, and other essential bills. Next, 30% or $600 in John's case, should be designated for wants. This could be anything from dining out to buying new gadgets or even going on a vacation. Finally, the remaining 20%, which in John's case would be $400, should go towards savings or paying off debt. This could be anything from building an emergency fund, saving for retirement, or reducing credit card debt. These two rules, the rule of 70 and the 50-30-20 rule, are practical and straightforward. They provide a quick way to understand the impact of inflation on our money and a simple method to manage our income effectively. The rule of 70 and the 50-30-20 rule are crucial for understanding inflation and budgeting. Scene script. Let's dive into the 3X emergency rule, the 40% EMI rule, and the life insurance rule. First up is the 3X emergency rule. This rule stresses the importance of having an emergency fund that is 3 times your monthly expenses. Think of it as your financial safety net. Life has a way of throwing curveballs, and this rule ensures that you're financially prepared to face them. Imagine a sudden job loss, an unexpected medical expense, or a major car repair. These are all situations where having 3 months' worth of expenses tucked away can make a significant difference. Next, let's talk about the 40% EMI rule. This rule is a guideline for those considering taking a loan, particularly for big-ticket items like a house. The rule states that your equated monthly installments, or EMIs, should not exceed 40% of your monthly income. Picture this. You've found your dream home, but the EMIs would take up half of your monthly income. This would leave you with barely enough to meet your other needs and obligations. By following the 40% EMI rule, you can ensure that you're not biting off more than you can chew financially. Finally, we come to the life insurance rule. This rule suggests that your life insurance coverage should be 10 to 15 times your annual income. Life insurance is not just about covering funeral expenses. It's about providing for your family, paying off debts, and ensuring financial stability for your loved ones, should anything happen to you. Therefore, having a life insurance policy that is 10 to 15 times your annual income can give you peace of mind, knowing that your family's future is secure. These rules help ensure financial stability and secure your family's future. By building a robust emergency fund, keeping your EMIs in check, and obtaining sufficient life insurance coverage, you're not just managing your money, you're also safeguarding your financial future and that of your family. So keep these rules in mind as you navigate your financial journey. Remember, financial wisdom is not just about making money, it's also about keeping it and growing it. Finally, let's explore the rule of 10 and the 4% rule. These two rules can help you make smart purchasing decisions and plan for a comfortable retirement. First, the rule of 10. This rule is a handy guide to help you decide whether it's worth purchasing an item new or used. Here's how it works. If the cost of repairing an item is more than 10 times the cost of buying it used, then it's worth buying new. Let's say you've got your eye on a used car that costs $2,000. If the cost of necessary repairs exceeds $20,000, you're better off buying a new car instead. This rule helps you avoid the trap of false economy, where you think you're saving money by buying used, but end up spending more on repairs in the long run. Next, we have the 4% rule. This rule is a guideline for retirees on how much they can safely withdraw from their retirement savings each year. The rule suggests that if you withdraw 4% of your total savings in the first year of retirement and adjust that amount for inflation each subsequent year, you're unlikely to run out of money for at least 30 years. For instance, if you've saved $1 million for retirement, you can withdraw $40,000 in the first year. By following this rule, you can maintain a comfortable lifestyle in retirement without worrying about depleting your savings too quickly. Just remember, these rules are guidelines, not guarantees. They're tools to help you make informed decisions about your finances, but your specific circumstances may require a different approach. And there you have it, 10 rules that can guide you in managing your finances effectively. Remember, financial success is about making informed decisions.